Hey everyone, welcome back to Corporate Decoder. Today, Fidelity Advisor Series IV just filed its semi-annual shareholder report for the Fidelity Limited Term Government Fund, and I'm digging into what's really going on with their investments. Quick note, this is not financial advice, just my take on public filings for educational purposes. This report gives us a really close look at how this fund managed its money over about 6 months. What is interesting is how much of their money is tied up in very specific types of US government and mortgage-related debt. Alright, so we're looking at the Fidelity Limited Term Government Funds report covering the period from the 1st of December 2025 to May 31, 2026. This is essentially a snapshot of their investment performance and holdings during that time. Now, let's talk about what this fund actually invested in. As of May 31, 2026, a whopping 78.5% of their net assets were in US Treasury obligations. That is a huge chunk, indicating a very conservative approach, mainly focusing on debt issued by the US government. Digging a bit deeper, we see they also hold quite a bit in collateralized mortgage obligations, making up 5.6% of their net assets. These are basically bonds backed by pools of residential mortgages. Think of it as repackaged home loans bundled up and sold to investors. Then there are commercial mortgage securities, which account for 9.7%. These are similar to mortgage-backed securities, but they're backed by loans on commercial properties like office buildings or shopping malls. That's a significant amount, showing a notable exposure to the commercial real estate-backed debt market. They also have 3.9% in US government agency mortgage securities. These are also backed by mortgages, but the agencies that issue them are government-sponsored enterprises like Fannie Mae and Freddie Mac. But circling back to the main player, the US Treasury obligations, this 78.5% is really the story here. This fund is heavily invested in US government debt. Looking at the specific holdings, we see significant amounts in US Treasury notes with various interest rates and maturity dates. For example, they hold over $6.5 million in notes maturing in October 2027, paying 3.58%. And they've also got us treasury bonds, like this one with a 4.625% interest rate maturing in November 2044, representing over $28,000 in that specific holding. Interestingly, their total investment in securities, after accounting for everything including derivatives, comes out to 101.5%. This means they are leveraged, meaning they are using borrowed money or other financial instruments to magnify their potential returns, or in this case, their investments exceed their net assets. This is balanced out by net other assets and liabilities, which essentially bring their total net assets to 100%. So, while they are invested beyond their net asset value, the overall financial picture is zeroed out. Let's look at the statement of assets and liabilities. As of May 31, 2026, their total investment in securities, including both unaffiliated issuers and Fidelity Central Funds, was over $161 million. Their net assets, which is what is truly theirs after liabilities, stood at just under $160 million. The net asset value per S-share was $9.68. Moving to the statement of operations for the 6 months ended May 31, 2026, we see their investment income from interest was over $3 million. That's the money they earned from all those US Treasury notes and bonds. After deducting expenses, their net investment income was about $2.9 million. That is a positive number, meaning they earned more from interest than they spent on fees and operating costs. However, when we look at realized and unrealized gain or loss, things get a bit more complex. They had a net realized loss of over $600,000 from selling investments. And the change in net unrealized appreciation or depreciation on investment securities was a loss of nearly $1.4 million. This means the value of their existing investments went down during this period. All of this combined resulted in a net increase of about $952,000 from operations. So even with losses on investments, the income they earned was enough to show a small positive growth in net assets. Now, let's quickly look at the financial highlights. The net asset value per S-share at the beginning of the period was $9.79, and it ended at $9.68. This means the value per S-share decreased slightly over these 6 months. Their total return for this 6-month period was actually positive 0.61%. This might seem small, but it means that despite the decrease in net asset value per S-share, the income generated after expenses brought the overall return into positive territory. The portfolio turnover rate was quite high at 113%. This means a large portion of the fund's holdings were bought and sold within the year. A high turnover rate can sometimes lead to higher transaction costs and potentially accelerate capital gains distributions, which can be less tax efficient for investors. It's also worth noting they have investments in what are called Fidelity Central Funds. These are essentially other Fidelity investment companies that the fund invests in. It is like a fund of funds situation. For example, they have about $331,000 invested in the Fidelity Cash Central Fund. This is a common practice for larger fund companies to manage cash or short-term assets. When it comes to how they value their investments, most of their holdings, over $161 million, are categorized as level 2. This means they are valued using observable inputs like quoted prices for similar investments or interest rates rather than direct market prices for the exact security, which would be level 1. This is typical for many bonds and mortgage-backed securities. Only their money market fund investments and futures contracts are valued using level 1, meaning direct quoted prices. The fund actively uses derivatives, which are financial contracts whose value is derived from underlying assets. They've used futures contracts, swaptions, and swaps. These are tools that can be used to manage risk or to potentially increase returns. Much of this derivative activity is related to interest rate risk. They're using instruments to manage how much their investments might be affected by changes in interest rates. For instance, they have a significant position in purchase swaptions, which are essentially options on interest rate swaps, with a total value of over $684,000. Looking at liabilities, they have payable for investments purchased of over $643,000 for regular delivery and over $3 million for delayed delivery. This shows that there were many investment transactions that had not yet settled by the end of the reporting period. Their net assets are made up of paid in capital of over $179 million and a total accumulated earnings loss of a negative $20 million. This negative accumulated earnings indicates that over time, the fund has distributed more to shareholders or lost more from investment performance than it has gained. The statement of changes in net assets shows that over the 6 months ending May 31, 2026, net assets decreased by over $8.3 million. This was primarily due to share redemptions, where shareholders sold more shares than they bought or reinvested. From an income perspective, the fund earned about $3.18 million in total income. Expenses, on the other hand, were much lower, around $246,000. This is where the significant difference between net investment income and net realized and unrealized gains and losses becomes clear. The fund is making money from its interest-bearing assets, but the market value of those assets or other investments declined during the period. Specifically, their futures contracts saw a net realized loss of $655,000, and swaps contributed a net realized gain of over $317,000. The change in unrealized appreciation or depreciation on investment securities was a significant loss of almost $1.4 million, meaning the market value of their holdings decreased. This fund is heavily concentrated in US Treasury obligations. While this offers a level of safety, a significant portion of their portfolio is also in mortgage-backed securities. The performance of these segments, combined with their use of derivatives like swaptions, which are complex financial instruments, suggests a strategy aimed at generating income while also managing interest rate sensitivity. The report indicates the fund experienced a dip in the market value of its investments over this period, leading to a net decrease in assets. The biggest takeaway here is the fund's heavy reliance on US Treasury debt, which is generally considered low risk but also typically offers lower returns. The inclusion of mortgage-backed securities and derivatives adds a layer of complexity and potential risk. I'll be watching to see if this strategy allows them to navigate potential market shifts effectively, especially in the mortgage-backed securities sector, which can be sensitive to interest rate changes and economic conditions. That is my take. Stay decoded.